Most of us feel the economy at the gas pump or the grocery checkout, where prices for basic survival have climbed steadily over the last few years. But if you look at the stock market, you see a completely different reality. Despite global instability, major indices are pushing into record territory. This gap exists because the stock market functions independently of the real economy. It doesn't track the well-being of the average household. It tracks the valuation of specific corporate entities. To understand why these two worlds are drifting apart, we have to look at the four specific metrics the market actually prices: future corporate profits, interest rates, the flow of capital, and the technical actions traders are forced to take. Examining the market through these four mechanical gears explains how the stock market can reach new highs, while everyday economic conditions remain stagnant. When we talk about the market, we are usually talking about a small group of massive, publicly traded corporations that operate on a global scale. This concentration is visible in the S&P 500. A tiny group of corporate giants accounts for a massive share of the index's value. The market can rise even if smaller businesses are struggling. Investor psychology adds another layer of insulation from the real world. Markets respond to expectations, not just current events. If investors spend weeks bracing for a cataclysmic supply chain collapse or a major oil shock, and the actual news is only moderately bad, the market often rallies. It isn't a sign of growth, but a sigh of relief. A record-high market reflects the earnings power of the world's largest companies and the shifting sentiment of traders, both of which can thrive in a world where the average person is falling behind. In a typical cycle, central banks lower interest rates to encourage borrowing. This makes cash less attractive to hold, pushing investors into assets like stocks and real estate to find a return on their money. Currently, interest rates have remained elevated, yet stocks are still hitting record highs. This suggests that the market is being sustained by a massive influx of capital that hasn't yet been neutralized by high borrowing costs. This chart tracks crisis spending. Government-injected capital passes through consumers, who spend it on survival, quickly pooling in corporate accounts. Institutions don't need this capital for survival, using surplus to purchase limited assets, forcing prices higher regardless of the broader economy. The result is a cycle where asset prices rise as a direct byproduct of capital pooling at the top, making the entry point for stocks and housing increasingly difficult for those who don't own them. Large-scale investors are also reacting to the scale of government debt, which now sits at roughly $39 trillion. When interest payments alone cost billions every day, trust in the long-term value of cash begins to erode. To protect purchasing power, massive amounts of capital are moved into hard assets like gold, serving as a hedge against the potential devaluation of money. Finally, much of the market's momentum is automated. Trend-following algorithms trigger massive buy orders whenever certain technical levels are breached, regardless of geopolitical news. This is amplified by market makers who sell options. If enough people bet that a stock will go up, those firms are forced to buy the actual stock to hedge their risk, creating an artificial loop where buying activity forces more buying activity. This combination of automated trends and forced hedging creates a self-reinforcing system, climbing higher even as the real world becomes increasingly unstable. While the stock market continues its digital ascent, the physical economy remains in a state of visible stagnation. The disconnect between these two worlds is no longer just a trend, it's a structural reality. History suggests that when asset prices move this far away from the economic reality of the people, the resulting imbalance eventually forces a correction. The immediate cost of this gap is the erosion of the middle class. As the price of assets like stocks and homes climb higher, the path to building long-term wealth becomes much narrower for those starting from zero. Navigating this environment requires looking past the daily headlines and understanding the underlying mechanics of how capital is actually moving today. To help you understand these concepts without the gatekeeping of complex terminology, I've put together a financial jargon cheat sheet. It's a free resource designed to help you clarify the mechanics of modern finance. You can find it at the link below.